All right, let's dive into my LMND Q3 preview video. So here was the guidance that management gave for Q3. We got IFP 1.1 billion, 145 million or so, gross earned premium, roughly, a little less than a quarter of that, 268 million, revenue 184 million, adjusted EBITDA loss minus 35 million. I'll give you the numbers right away, and then we're going to my potential numbers that I'm getting, and then I'll give you the backing behind that and go into a few more little nuances for this quarter. So I have my normal Lemonade model available to Patreon members. At one point in time, I did make right here a Lemonade guidance versus actual results. And so you can see revenue, IFP, gross earned premium, and adjusted EBITDA, what they guided for at least the quarter prior. And then obviously they guide several quarters out for the full year each year, but this would be the number they gave the quarter before and what they actually came in and what the beat was. So, and then in Q3 here, I have my own predicted kind of potential numbers. So they're guiding again revenue, IFP will start there. I'm having a 1% beat, just a little bit over that. If we look at IFP, and this is as a percentage basis beat, you can see they're often beating it by kind of 1-2%. It was more significant going back, a couple years ago, and I think their guidance has become a little more precise and accurate in that. So, and also as your book of business grows, a 1% beat now in the book of business now is a much bigger sort of dollar value than 1% beat back number of years, 5 years ago. So that makes a difference too. But on a percentage basis, you can see it is sort of declining. I just have a 1% beat there. On a revenue basis, I'm having basically just exactly hitting the revenue. Maybe I'm a little bit conservative there, and we have a little bit of a beat based on just how that typically has come in at. Gross earned premium similar, have a very close there, but just a very minor beat. If you look at other Q3s, these could be slightly conservative that way. On adjusted EBITDA basis, I'm having a much bigger beat. And sometimes adjusted EBITDAs can be a little bit tricky because maybe there's some kind of one-time adjustment they're planning to make, or something that's hitting the financials that we don't really know, but they know is going to hit it in Q3, and it's hard to predict that. So that could definitely be affecting it. But I have minus this could be a significant beat here on adjusted EBITDA. Depends really what their loss ratio comes in at, and we'll look at that here in a moment. And it depends sort of how much they spend on marketing. Also, those are two factors: the loss ratio, what that comes in at, and then how much they're spending on growth spend, marketing spend in the quarter, which is a little bit more discretionary, and sort of how effective is that marketing on a unit economic basis and converting that into IFP dollars. So again, we're looking at it, and more important for me than like hitting this number exactly, and my adjusted EBITDA prediction is spot on or not. What matters, I care more about, and I think be better for you to understand, is what sort of the variables that drive this could swing this up, so that we get a 10% beat or a 30% beat. What would move it between that? I think it's very likely adjusted EBITDA is going to beat that range there, but more about how much, because it's still the 35 million is the middle, 35.5 million would be the middle of that range. So what I'm plugging in is adjusted EBITDA, is minus 26 million, just like something like that. So, okay, let's dive into a few more details in the quarter. First was the Texas floods. So Shady Josh, well, first of all, let's talk about the Texas flood. And this was back closer to when it happened in July. So that happened in Q3. Was one of the only sort of newsworthy catastrophic events that I'm aware of in the quarter that could be affecting Lemonade. And basically this post here, I'll link this down below in the description, but basically saying, there maybe is like 7,000 to 10,000 cars. I asked Grok to give an estimate. The nearest 1,000, it said about 9,000 vehicles destroyed, so that checks out. And they're one of maybe, they're not even the top 40 auto insurers in Texas. So he's only estimating maybe, say there's 10,000 cars that were destroyed. 8,000 of those are maybe insured, and Lemonade has even 1% share and 25,000 a car. It might be a loss of $2 million. Like not significant at all in the grand scheme of things, or even for this quarter scheme of things. And even that, Lemonade, he says Lemonade has a long time fronted a lot of Texas auto coverage to third-party companies. So a lot of Lemonade's book, insurance is really broken down by product and geographies, and there's different strategies and reasonings and rationale and why they would do that in each state and area or country that they're in. But so my guess is the Lemonade Texas floods are really a nothing burger. The other sort of way you can think about it too is the guidance. If you look at the guidance, say adjusted EBITDA guidance for full year 2025, that this was in Q1, so before the floods happened, they gave the guidance that said $140 to $135 million loss. But then after the events happened, so the Q2 results with the Q3 and the full year guidance, they're still guiding the exact same thing for just EBITDA, minus 41, minus 135. And this was already, about a month. These came out about a month after the Texas floods happened. Those were in July, around, I think, start of July, and this was around, first week of August that these results for Q2 came out. So my guess, Texas floods are going to be very insignificant and very low, sort of on the whole quarter as a whole. I think is going to be very low on the catastrophic event side of things. If you look, let me flip to my model. It lead me into just chatting about the loss ratio for a moment. If we flip down in my model here, again, this model is on my Patreon if you want to join there. Lots of others have. Super cool. Encouraging to see people do that. But I haven't filled this out as dutifully or perfectly as I should have the last few quarters. But one thing I have been tracking is still Progressive's company-wide catastrophic loss ratio, sort of what they're attributing to catastrophic losses, and then the property insurance, which is maybe your catastrophic loss ratio as well for Progressive. Progressive's nice because they release it month at a time, the data, and so I just took the average across the 3 months here. It was very low, with only 1.1% across both of those metrics versus, property can fluctuate a lot. We had a quarter, it was 75% catastrophic. Just the catastrophic losses in your property portion of the book of business, 75%. In other quarters, 20%, or maybe some adjustments where it's a slight negative. But right now, and the whole book of business, like Progressive had a very good quarter, was only 1.1%. And I'm going to pull up, leading into the Progressive loss ratio. I'll just chat about this for a second now too, with my Patreon here. I have a server, and Prin, who's, shout out to him, he's on X on Twitter too, was super bright, smart guy, was chimed in basically that you can pause here and read this if you want. I'm not going to read it all, but Progressive was down in their Q3 results and was mainly from a policyholder credit in Florida. So there's some sort of specialty things that are happening in Florida, but otherwise, it's actually, without that, would have been a pretty strong quarter for Progressive. So I think catastrophic wise, loss ratio wise, we should be really good. Now I'm flipping over here to, this was the Q2 results of 2025. If you look at gross loss ratio X cat, so no catastrophic events happened, look at the last few quarters. Like, it's really amazing. We were at 62, 68, 62, 59, 60. Even as car has started to ramp up over the last, couple quarters, we're starting to see effects of your IFP in car. Like, look at car IFP. It went from 122, was barely moving, like 117, 122 is only 5 million. Even decreased the quarter before that, and then it went from 122 to 134, so 12 million more, 134 to 150, so 16 million more, and that's going to keep, you wouldn't be surprised if this is another, maybe it's 16 to 20 million add to car. And the car loss ratio is at 82%, Europe also is growing quicker, and it's at 83%. So those kind of growing, those faster growing, those starting to take off portions of the business, starting to accelerate more, is sort of in the IFP, are going to be carrying a little more weight. So that could push your sort of overall gross loss ratio ex cat up a little bit higher. But we're still seeing it at 60%, still 60%. And you kind of got to wonder, like, look, Q4 2024 was only 1% cat in Q4, and I'm just gonna flip. It's not apples. It's not a good comparison really at all. But Q4 for Progressive was again super low, 1% and negative 1.8%. So it makes you wonder, like, maybe the cat portion is going to be similar. Maybe it's going to be like a 1%. And out, like, it's possible maybe you're going to have a gross loss ratio that's like 61%, like something really low. And the market, I think, they're going to love that. That's not even what I put in my model to get that massive adjusted EBITDA beat, where we're talking about like a huge beat, which again, I think, I think the quarter's gonna. I'm pretty bullish on this Q3, and I don't know I don't always know how the market's gonna react. Sometimes I think, yeah, the market, it was a slam dunk of a quarter, and then the market reacts with nothing. Other times I think, yeah, it's again a slam dunk of a quarter, and then the market goes crazy afterwards. So I don't know where we're gonna go, but I wouldn't be surprised. Nothing would surprise me. Literally nothing. Like if we were in $120 a share a month from now, that I would not be surprised at all. If we have a slam dunk quarter and we beat adjusted EBITDA by 30%, and the stock does absolutely nothing and sits at 55 for another 6 months, I would not be surprised either. So I'm not surprised either way, but I think it's going to, performance wise, I think it's going to be a strong quarter. I don't think we're dropping to $30 a share or something, if you had to ask me, at least my opinion. Again, not investing advice, but based on what I'm researching, what I'm seeing here. So because I'm seeing this sort of a beat here is based on, let's go back to my model here and look at the loss ratio I put in. I put in a 66% gross loss ratio. So again, I'm saying it's possible we might even hit like 61%. And this is a bit, even if you look at, I have a product mix here down below this black line. There's a couple black lines. The second black line down, I have I have a gross loss ratio based on how each product might be growing and each product's sort of potential loss ratio, what it might be at. I have like car going to 78% loss ratio from 80, and based on the sort of mix and how that's growing, it's calculating like a roughly sort of overall. This is factoring in and including sort of catastrophic events and everything. It's a 66% loss ratio, but obviously there's more fluctuations quarter to quarter because you have some catastrophic effects that can really fluctuate, move your loss ratio around. But I have 66%, and then I am putting net in at 68%, so a 2% difference. That was what it was last quarter. Other quarters, it's been, it can be even or slightly off from that. But that's what I'm putting in there for that right now. And that gets you to that, based on my other inputs. Sorry, I'm in the wrong column here. Move over 66, 68%. And that gets you down to that adjusted EBITDA of, about a minus $26 million loss. Versus, again, what they're guiding, which is only 37 million. So that's a huge number. The other way I'm sort of thinking about this is your IFP is growing at a certain rate, and you hit 29% year-over-year growth, and it keeps accelerating. It was 27%. So if that creeps up a little further, you're at 30% year-over-year growth, and that's where you get that little bit of a beat on their IFP. Depends how your revenue comes in at, sort of how your investing comes in at investment income, but your revenue have at 185, basically very close to what guidance is. And your reinsurance, just a touch on reinsurance. Reinsurance is going to taper down from the 55% it was down to the 20% it's moving to by next year. That's going to really accelerate your revenue. So, I don't even really think about revenue too much as an insurer, because I think it's better to think about what the top line moving at and sort of what your bottom line's moving at. So yeah, again, as your reinsurance tapers down, it's going to sort of dramatically push the revenue numbers up. Sorry, I'm traveling right now, and there's someone below me, around me, some kind of whiny vacuum. That I don't know if you can hear that. Hopefully not. But so, anyways, your reinsurance, that's going to be a story over the next year as your reinsurance comes down. You can see in like 2025, or your revenue is 715 million, and then 2026, I'm like almost 1.2 billion. So massive increase coming in your revenue. That's even with part of it still tapering down. So even if you look out the next 2027, if reinsurance is the same structure, it could be even more significant. But yeah, so revenue will be an important thing, interesting thing. I think a storyline coming forward, as it's going to jump up dramatically. Your IFP is still going to be growing, not the same percentage rate, but probably in the low 30s% here shortly. So I have, again, back to this quarter, I have an IFP growing at 30%. And the way I'm sort of modeling and thinking is saying, look, they have these plans to grow at a certain rate. If they hit that target, what does it take in marketing spend to get there? And if I pull up the earnings call here, I actually tweeted this out. This was a Q1 earnings call. They said basically from growth spend perspective, they plan to invest about 45 million in Q2, and then maybe even a little bit more in Q3, and then somewhat less in Q4, for around 170 million for the year. Now they actually did more in Q2. They did close to almost 50 million actually was spent in Q2. So maybe the whole year, I'm sort of expecting maybe the whole year is going to be more like 175, 180 million in total spend. So this is the most misunderstood thing about Lemonade, is that you're spending money now. You're investing heavily in acquiring customers because you're almost entirely direct to consumer insurance company. So what they're spending on marketing to get there is really a critical question, along with the loss ratio. Yeah, because one of the most misunderstood things about Lemonade is you're spending money right now in this quarter to acquire customers, but those customers are some of those customers will be with you for decades and pay you back in gross profits and profits for decades of time. But all of your expenditures right now for this asset, this customer that you're getting, that could be with you for years and years. And so Lemonade sees that, understands this unit economics, and is investing heavily in the current quarters because they know it's a good investment. They can measure those investments for with a predictable future. So so that's a little tangent, but that is I would say the number one most misunderstood thing about Lemonade, because people just say, oh, they're losing so much money. Well, part of the reason they're losing so much money is they're going to spend 170 million on growth spend this year. Like, it's a wild amount of money. So here's in my model here, I have sales and marketing growth spend. I had 8 million in Q1, about 50 million, like I said, in Q2, more than they predicted there. And then I have about 45 and 42 million. Maybe this one's going to be even more in Q3. This could, if this was higher, that could lower my adjusted EBITDA. But the way I have this figured out is I input a CAC, or customer acquisition or growth spend, and a conversion rate of IFP. So I have it converting. Previous quarters was 2.74, 2.37. I have a 2.5 in this quarter and 2.8 in Q4. But for Q3, 2.5. Kind of roughly gets you to the whole year 175 million total growth spend over the 4 quarters, which close to a little bit above what they were predicting in Q1. So but based on that, this conversion is really important, and is quite uncertain right now because car is still ramping. Like, they've mostly been playing in these little renters pet insurance markets, which are significant, and pet insurance they're going to dominate in. And pet insurance is probably going to grow from whatever 5 billion market just in the US now to, like, fast forward 5-10 years, could be like $20 billion market. It's just going to be massive growth within that segment themselves. But now they're starting to grow into dabble in, like you see their IFP for car. If you go down here again, was only 150 million of car IFP, pretty small in the grand scheme. And car market in the US is something like $300 billion plus. So once you start playing in that market and you pick the lowest hanging fruit, we'll really see what these numbers could come in at. Because the bigger the number here, the better. It just means you're converting more effectively your growth spend into IFP dollars. So I have 2.5. I have a graph here of historical measures of. So here's a graph. Let me just zoom out a little bit. This is Here's your how much you're spending on growth spend in a quarter, and then what your conversion rate came in at. So you can see as you spend a lot less, it's kind of a bit of a like a swoop, Nike swoop or something. Here it comes, swoops up, because as you spend less and less dollars, each dollar is much more effective. But as you spend more dollars, each dollar eventually, sort of incremental dollar you spend, is less effective. So but if you're expanding your product lineups, your car market, everything's growing, you have more places you can market to, then you become more efficient. That's why I've talked about this in other videos. That's why you see this sort of an average trend line here, but you see above this trend line, look, we have Q4, Q1 and Q2 were both above the average. So as you can see, the last few quarters were sort of bucking the trend and pushing this effectiveness up, versus prior quarters back here and even below, where like 2021, we were now below the trend. Even last year, 2024 Q3, we spent a lot, but we're a little bit below. That's why I'm thinking, they're going to spend maybe a little less than Q2 actually, or somewhere close to it. Like a 2.5 ratio might be somewhere plausible. And then as car really ramps, or there's really low hanging fruit of people that are waiting for car, and car comes to them and they can convert and sign up to car with no marketing cost, then that really pushes that ratio up. So it's really critical what this ratio is. I would say that two of the biggest sort of variable to depict, like what I'm trying to model out the quarter, is what's my loss ratio and what's my conversion rate on marketing. Nobody talks about conversion rate on marketing, but I have this, the way the model's set up and built, you can just play with this number. Like, if this one is high as 3, then you're going to spend a lot less on sales and marketing to get the same IFP. And then if you scroll down, your adjusted EBITDA is going to be even less, like minus 18. But say this is not as good. This is like 2.25. I'd be then you're at minus 31. Still a beat even on what they're guiding, minus 34, but not as significant of a beat anymore. But then it would mean, to get to the same kind of level of growth, top line growth, you're spending more on marketing as well. So you're kind of reversing what they said in how much they're sort of, then you'd be in more than the 175. You'd be off from this, and to be surprised, because they're pretty precise in sort of what they're allocating for the marketing and what they're expecting, that to reach the top line. So those are really, really critical. There's other numbers here we'll just touch on, like other insurance expense. This can be really jumpy. Like last quarter, it dropped 18% quarter over quarter, jumps around, but I have it again. It's 8% of gross earned premium and growing about 5%. Tech development growing 2%. G&A growing third. It was way down. There was sort of one-time event, and then since it's slightly below what it was prior is what I have. Maybe it'll be higher then. Maybe there's one-time kind of things that are factored in there, and that's going to worsen their adjusted EBITDA. That it's hard for us on the outside to predict. Definitely possible. But your total operating expenses, everything in, it's creeping down. It's 50% from, it was in the mid 50s or high 50s, or not that long ago, or even 60%. So that's just going to keep improving until they become fully profitable. And your total OpEx minus growth is a 90 million. Look, we were at like, before last quarter, that one-off thing, we're at like high 80s. So that's just barely creeping up. This is all the operating expenses minus your growth spend, which is sort of the more discretionary ramp up or down, depending on how quickly you want to aggressively grow. So that's, around 88 or 90 million, I should say, and 6% growth year over year. So yeah, all that in, you get to adjusted EBITDA of about minus 26 million. Now, you could maybe some of these operating expenses are higher. So you add a few $1 million, you add a couple more $1 million in here, 2-3 million more. Well, you could go from 26 to 28, 29 million pretty easily, 30 million easily. And you wouldn't have quite as significant a beat, like say flip over to this and say this was, minus minus if I can type minus 30 million. You still have a 15% beat, significant beat still. You look at other Q3s, like Q3 of last year was a minus 14% beat, but not as significant maybe as I'm thinking it could be, which is more like 27% beat. But you can see sort of the effect of that, right? That's really what I want us to think about, understand. The hyper sort of bullish case, you could be like, oh, the marketing's even more efficient. They're 2.65 and for what they're going to spend, and they spend $43 million on growth spend, and maybe the loss ratio literally is like 61%. That would be like the most monster quarter. You'd have $17 million loss on the adjusted EBITDA line. Market would be like, wow, 61%. I don't even like, I think that's like a decently possible. I'm not expecting that, but even an outcome like that, I would not be shocked by. But I'll turn that back. If we go the other way, more pessimistic side, maybe you say, oh, this is going to be not that good. It's 2.25 conversion there. And this is going to be, all these things are going to affect it. You're at 70% now. Your adjusted EBITDA now is minus 36. So those two variables really can swing it, and you would be at the higher end of that. I think that's too pessimistic both of those inputs. So even, I just don't see how the loss ratio would be that high based on based on how I'm factoring in the how each product would grow and their loss ratios. It would be still surprising to me, because even like, see here, even my home loss ratio, and they don't break out home and renters, so it's an estimate, but I have a 97% home loss ratio now. If catastrophic events are really, really limited for the quarter, you'd think this could be 80%. Like if this is 80%, then your sort of overall would actually be 63%. I'm just going to undo that so I keep my logic, but say 63% gross loss ratio. Like say I punch that in, well, now you have adjusted EBITDA, it's like minus 22. So again, even beating what I'm predicting, more like that's probably going to be more like a 30% beat. Say minus 22. Yeah, you're 38% beat, like a monster, one of the biggest beats ever. So as a whole, I'm pretty bullish on this quarter, and I think the numbers, they could have a pretty decent beat on the bottom line, unless there's something I'm really missing or misunderstanding, or there's some more sort of one-off events. But on a catastrophic basis, I think a loss ratio basis, I think it could be really, really strong, and even I wouldn't be surprised. You just flip back to this gross loss ratio ex cat. This tells you almost everything you need to know. Gross loss ratio ex cat has been trending super low. Progressive had super low catastrophic events for the whole quarter. And Lemonade, Texas floods are probably a nothing burger, like really, really minor in my opinion. And so your like where's the it wouldn't be surprised if you have 62% loss ratio or some like gross loss ratio, some crazy good number like that. And then even these adjusted EBITDA on this range is even better than I'm showing right here. Maybe like let's punch one more thing in for fun. Let's say that's like 62%, and let's say this is not as strong. Maybe this is 2.37, just like last quarter. You're still getting adjusted EBITDA of minus 23, even better than I'm showing here in this sort of minus 27. You're still going to have like okay, minus 23. You still have a 35% beat. It's still crazy. Really, really, really strong beat. I'll just turn these variables back though to what I kind of plugged in there to start with. And yeah, so I think it's gonna be a bullish quarter, and I've been saying for a while. I think at some point this is really gonna slap these numbers, these investments that Lemonade's making, and how they're gonna pay off are gonna slap the market in the face, like just hard smack in the face, and the stock could do crazy things. Like, again, nothing here on my channel is financial advice, but I think crazy. I would not be surprised, literally, like anything, like $300 a share, like in sudden over the course of just months, just massive moves. Anything like that could happen, or or the market doesn't get it until it's way too late, and then at some point we have the massive move. But like I've been saying a Q1 will be important because Q4 results will come in like February of 2026, and we'll get the final results for Q4, which will be probably very strong, and then we'll get the whole guidance for 2026. And they might adjusted EBITDA loss right now for this year, like has been guiding 130 million dollar loss, and then next year suddenly they might guide like a $6 million loss for the whole year, with the back half of the year being positive, like or might be close to break even, so that will be a slap you in the face moment. It's like, wow, it's like, wow, the numbers really are clearly turning around, got smacked in the face. But it might even happen like Q3, because like this quarter coming up next week will be a smaller version of that, because we're going to get Q4 guidance is kind of like I showed here in this post, that Q4 right now, their adjusted EBITDA based on what the losses for Q3 and for the full year, the Q4 adjusted EBITDA you can figure out is they're only guiding for a $13 million loss. And there's a good chance that will be the same or maybe even improve. So you might have a Q4 like guide at the better end that is going to show up, right here under Q4 2025 in the next letter, and in the next week might say -10. And that could be like a smack in the face moment where people are like, man, this company's not just pouring money down the drain. Wait a minute, they've been making investments with the money they're spending, and those investments are starting to pay off. And they're not just been making investments, they've been ramping up their investments. So if I go to my model and pull up, I have a growth spend history. You can see like the growth spend came down and then has massively ramped up, and we're going to have more and more quarters like in the 50 million range or even higher growth spend. And so that's why you're aggressively increasing your investment, and then quarter by quarter the finances continue to look bad until they don't. And that's what I mean. That's the inflection point where you get smacked in the face, and the people that were way too late to this and way too slow and way too critical and way too surface level will get wrecked. Or the people that don't care, don't even think about it, and are short lemonade just because they think they're just like a meme stock. That's when those people, I think, will get absolutely wrecked on their short position. That's my opinion. Not financial advice to anyone on either side, but that is how I think it's going to go down. So, yeah, anyways, I think it's going to be an awesome quarter. I'm very excited for it. And hope you enjoyed this. Hope you learned some things. And let me know what you think down below in the comments. Thank you so much for watching. Oh, yeah. Also, you can join my Patreon if you want to get full access to this model, and also share this spreadsheet on my Patreon as well with show that guidance history. But thank you so much for watching. And remember, it's in the bag.